I'm Dr. B, and yes, I'm a real ER doctor, so you may be wondering, what am I doing here in this space? Well, after years of pain from sports injuries, I listened to my doctor and had to pivot into a career that would keep me off my feet as much as possible. I also have a degree in finance, and so it was a natural transition to join Verified Investing. I'll share my prescription for becoming a successful investor right here on the Market Pulse.
Welcome to the Market Pulse. I'm Dr. B here at Verified Investing. Today we're going to be talking about the fear indicator, or the VIX. Okay, it's very important to understand this. This helps you get an overall picture of the market sentiment, and where we're at. Let's move over to the charts. All right, so the fear index, the VIX. All right, the VIX is the CBOE volatility index, and it represents the market's expectations for the relative strength of the near-term price changes in the S&P or the SPX. It's derived from options, near-term options that are expiring on the SPX, and attempts to project the 30-day volatility over the next month or so. So why does this matter? It allows us to gauge the sentiment of the market, allows us to understand if there's a lot of fear in the market or if there's no fear, and really it also allows us to hedge against downside. Before we talk about hedging, let's talk a little bit about what the chart looks like, what it means, and we'll go from there. So you can see here, this is the VIX on the weekly chart. You can see these two big spikes, the Great Recession and COVID. The Great Recession was right around 9 or 10, spiked all the way to 95 during the Great Recession. COVID, again, same thing, right here about 9 to 10, maybe 12, and spiked all the way to about 85 during COVID. Tons of fear in the market. The S&P falls and the VIX spikes, right? So there's an inverse correlation. You can see that this data comes back to the 1990s. If the Great Depression were charted here, okay, back in the 1920s and 30s, you probably see a spike up to the ceiling. All right, that's how much volatility and fear was in the market, okay, at that time. Okay, so I drew these lines in here, these circles in, to show you just about where the VIX tends to bottom out. And again, it's right around the 9.35 area, then it tends to move up. Currently, we're at 13, okay, and we're forming a wedge pattern here. You can't really chart the VIX. You really should be charting the S&P or the SPX, all right, and trying to look for trend lines or areas where it's likely to hit resistance and then come down. Again, when the S&P comes down, the VIX spikes, all right? And what you can do here is you can actually buy short-term futures contracts, all right, down here, say at 13, and if it spikes up to 50, like it does from time to time, again, this is about the average area where it spikes to. You can see these peaks right here, all over through this area, right around 48. You can have a several 100% gain by hedging against market downside by buying short-term VIX future contracts. So I'll talk a little bit about that shortly here. I just wanted to zoom in and show you this wedge that's forming on the VIX. You can see that we've had a lot of volatility here, but really for the past 2 years, okay, this is 2022 right in here, we really have just been in this range, and we really haven't had these big spikes that we've seen in the past up to the 30s, 40s, and 50 area. So we really are due for a spike in the VIX. We're due for fear in the markets. The S&P has just been floating up on light volume, pretty unbelievable. So what we'll be looking for is kind of a breakout here to the upside. And what you can do is you can actually start to buy some short-term futures contracts when you see the spike. Okay, it's very tough to time this, but when you start to see the spike, okay, notice here, as soon as you start to see it spiking, right, let's say you buy here, and you can get this, you can ride this higher, okay? Same thing here. As soon as you start to see it spike, you can buy As soon as you see this spike, you can buy and get in. So a variety of different ways to play this, all right? All right, so we talked about how the S&P is inversely correlated with the VIX. This is a chart. This orange line is the SPX, all right? And you can see when the VIX spikes, here's the downturn in the markets. VIX spikes, downturn in the markets, all right? The VIX spikes, here's your downturn in the markets. This is probably the Great Recession right here, okay? And then here's COVID, of course. Here's your spike in the VIX. Here's the drop in the S&P, all right? So really what we're looking for is, all right, when the S&P starts to pull back, all right, and it will at some point, all right, what happens to the VIX, all right? So you can buy short-term futures contracts down here and profit from that spike, all right? So we'll talk a little bit about that. So again, how do I make money with the VIX? You can buy what's called the VXX, which is a short-term futures ETN. Now this is the chart on the weekly. You can see here that the price just keeps going down and down and down, all right? This is called slippage, all right? So every month as the contracts roll over, you tend to lose value in the VXX, all right? This is why I have it bolded here, short term. This is only for short term. You should not own this long term. You will lose all of your money over time. Very, very important to understand that. All right, that's why you see it just keep going down and down and down. Where you can make money, okay, by going long the VXX is these types of spikes right here. All right, these types of spikes right here. All right, so let's zoom in a little bit here, and you can see this is where your profit opportunities are. Again, the ticker is VXX. All right, it's only for short term. After about 2 to 3 months of holding this, you start to lose the ability to profit unless you have a big spike. All right, because again, the natural curve of this short-term ETN is to the downside. This is where you can make your money. Let's say you're buying it right here. All right, let's say you're buying it here. You're adding here, so your average is there. It spikes all of a sudden. You're selling up in this area. You make a 100, 200% gain. It's really incredible how this works. But it's not easy. It's very difficult. If you try to time this, a lot of times, you will not get the timing right, and the price will just keep going lower and lower and lower. So if all of a sudden you see a big news event that will likely rock the markets, or inflation data that will likely rock the markets, this is something you can do to hedge against your long-term hold portfolio. You can use it for, to hedge against your short-term portfolio and your long-term portfolio. So very, very good. I hope you enjoyed that. That was the VIX. So I hope you enjoyed that episode of the Market Pulse. We talked about the VIX, the VIX. You may hear this on CNBC or other financial news channels, and you may wonder what this is or what it means, or even how to chart it or how to trade it. Now you understand. These are very important little nuances such as slippage in the VXX to understand, because there are probably some investors or traders who buy the VXX thinking that it's a long-term hold when really it isn't. So these are all the types of risk. You must understand what instrument you're investing in every single time that you are investing in it. So very good. I hope you enjoyed it. Go back and watch my previous episodes of the Market Pulse. There's a lot of information. I spend a lot of time and effort on this every single week, and I really try to put all of my knowledge into this every day and every episode. Click the links below. You can see my 1-minute scalpel course that we use in the Apex Day Trading Room every day. And very, very good. I'll see you guys next week. Take care.